Welcome to Business Today. I'm Michelle Fleury in New York, where traders may want to put on their hard hats. That's because US markets picked up where Japan left off, and the global stock market intensifies as the sell-off continues. There are two things that do seem to be driving it: Friday's disappointment about how few jobs the US economy added in January, and Japan's decision to increase interest rates last week. Well, as you can see, the US markets have opened sharply lower.
What if the market crashes tomorrow? Would your investment survive, or would you be left scrambling to pick up the pieces? The thought of a market crash is enough to send shivers down any investor's spine, but ignoring the possibility can be even more dangerous. With global uncertainty looming, rising interest rates, geopolitical tensions, and fears of a looming recession, 2025 could be the year that catches many off guard. The question isn't if the market will crash, but when. In this video, we'll tackle the ultimate question: how do you protect your investments from a financial catastrophe? Whether you're a seasoned investor or just dipping your toes into the market, this guide will arm you with actionable strategies to safeguard your portfolio. By the end of this video, you'll not only feel more confident about your investments, but also learn how to turn potential chaos into opportunity. So grab your coffee, settle in, and let's dive deep into how you can outsmart the next big market crash. Before jumping into the strategies, let's examine the warning signs. Understanding why a crash might occur in 2025 is crucial for preparation. Number 1. Inflation and interest rates. Central banks worldwide are continuing their fight against inflation, but their aggressive interest rate hikes come with consequences. Higher rates make borrowing more expensive, impacting everything from corporate growth to consumer spending. Historically, markets don't fare well under these conditions. Number 2. Geopolitical instability. From ongoing conflicts in Eastern Europe to rising tensions in Asia, geopolitical risks are shaking global markets. Any escalation in these regions could send shockwaves through international trade and disrupt major industries. Number 3. Corporate earnings decline. Many companies are facing declining profit margins as costs rise and consumer spending tightens. Weak earnings reports have historically been a precursor to market downturns. Number 4. Tech Bubble 2.0. The tech sector, despite its recent rebound, remains volatile. Speculative investments in AI and other emerging technologies may lead to a bubble, much like the dot-com era. Number 5. Debt concerns. Both governments and corporations are dealing with unprecedented levels of debt. If interest rates remain high, defaults could spike, further rattling financial markets. Now that we understand the risks, let's focus on how you can safeguard your portfolio. Number 1. Diversification. You've probably heard it before: don't put all your eggs in one basket. But true diversification goes beyond owning a handful of stocks. Consider these asset classes. 1. Bonds. Especially government bonds, which are less risky during downturns. 2. Gold and precious metals. Historically, these assets perform well during market volatility. 3. Real estate. Physical properties and REITs can provide stable returns even when stocks falter. 4. Cash or cash equivalents. Sometimes holding cash is the safest bet during uncertain times. A diversified portfolio spreads risk across different sectors and asset classes, reducing the impact of a crash on your overall wealth. Number 2. Reassess your risk tolerance. Ask yourself, how much risk can I truly handle? A market crash is the ultimate test of your financial resilience. Firstly, for conservative investors, shift towards safer assets like bonds or dividend-paying stocks. Secondly, for aggressive investors, consider reducing exposure to speculative investments like small-cap stocks or highly volatile cryptocurrencies. Your age, financial goals, and time horizon should guide your decisions. Number 3. Build an emergency fund. One of the simplest yet most overlooked strategies is having a robust emergency fund. Ideally, you should have at least 3-6 months worth of living expenses saved. This cushion prevents you from liquidating investments at a loss during a market downturn. Number 4, keep an eye on valuations. Not all stocks are created equal. Focus on companies with strong fundamentals, low debt, and consistent earnings growth. Overvalued stocks often suffer the most during a crash, so avoid chasing trends or speculative bubbles. Number 5, hedge your portfolio. Hedging involves strategies that offset potential losses. Some popular methods include 1. Options trading. Use put options to protect against significant declines in your stock holdings. 2. ETFs. These funds increase in value when markets go down, acting as a buffer. 3. Commodities. Assets like oil or agricultural products can serve as effective hedges. Number 6. Stay informed but avoid panic. News headlines during market crashes are often designed to provoke fear. Stay informed but don't make impulsive decisions. Emotional investing leads to mistakes like panic selling or buying during a hype cycle. Number 7. Have a long-term perspective. Remember, market crashes are temporary, but long-term growth trends often remain intact. Use downturns as an opportunity to invest in quality stocks at discounted prices. A market crash isn't just a threat, it's also an opportunity. Here's how you can leverage it. 1. Dollar cost averaging. Invest a fixed amount regularly regardless of market conditions. This strategy reduces the impact of volatility over time. 2. Tax loss harvesting. If your investments are down, you can sell them at a loss to offset taxable gains elsewhere. 3. Rebalance your portfolio. Use the crash as a chance to adjust your asset allocation to align with your goals. Market crashes are inevitable, but being prepared can make all the difference. By diversifying your investments, reassessing your risk tolerance, and staying informed, you can navigate turbulent markets with confidence. Remember, it's not about timing the market, it's about time in the market. If you found this guide helpful, make sure to like this video to help it reach more people who need this information. Subscribe to our channel for more expert tips on finance and investing. Comment below your strategy for protecting your investments in 2024. Let's start a conversation and learn from each other. Hit that notification bell so you never miss an update, and thank you for trusting us with your financial journey. Here's to securing your wealth and thriving in any market condition. See you in the next video.